I think we need to understand, okay, where have we been? Where are we today? Where are we going? What worked yesterday is not necessarily going to be working today, but we've been looking at the big FANG stocks. And so, there's been this saying that there is no alternative to like these 7 or 8 different stocks that just continue to lead everything.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. Well, we got job numbers, conflicting job numbers that came out last week. Does that mean that rates are going higher? And we've got the PPI, the CPI coming out this week. David Stryzewski is with us now to help us make sense of these numbers. David, what do you make of the job numbers? What do you make of the upcoming CPI and PPI numbers?
Well, great to be with you here, Kerry. A couple things. So in my opinion, the latest jobs report shows very conflicting information if you're looking at the difference between the JOLTS and the household surveys. So just for your viewers' information, when ADP, this organization that just does payrolls for all these different organizations, when they come out and say, hey, there's 500,000 new people that are working, what that's doing is it's interviewing different organizations and it's saying, do you have new employees? Now that could be full-time employees, part-time employees. As we look at the household survey, that's actually just contacting a household. They may have 2 different jobs working part-time at different places, so they might count as 2 on the JOLT survey. But when you call a household and they say, hey, I have a work, I'm working, there was only 209,000. So I think that we're getting a slowing system here today. And we're transitioning right now just to a slower cruising speed as we look at our economy right now. But, worker hoarding is something that happens here with basic economies as we, find ourselves in new places right now. Everyone's trying to wonder, hey, are we going to be in another bull market that's just going to continue to go up forever? I'm not personally of that perspective. I think the macro picture is very negative, even though we're seeing positive increases in certain parts of the market, if you will, here in the short term. But, the last part of an economy to go is the employment portion, because no one wants to fire anybody. And right now it's very difficult to find really good labor. And so, people are holding on. But this definitely shows a slowing for sure. In specifically, getting new workers. And a lot of that's just gone through, the services side of the world. Kind of getting into CPI right now. I think that we're actually probably, we're seeing, CPI numbers come down, PCE numbers come down. I think that it's going to, we're a long ways off from this 2% number, though, that the Fed really wants us to be at. And so I think that we're probably actually going to see things, begin to become more inflationary, which I understand I'm an outlier in that statement. But there's a number of things that are important for us to understand from that thought process. One, Milton Friedman taught us that where printing is not taking place, inflation is not occurring. Well, we're seeing printing take place at rapid rates right now. $10 trillion just went into our debt here in just less than 4 years, and we just committed to $4 trillion more over the next year and a half. That's very inflationary. Additionally, we're looking at right now a lot of things that are also inflationary, just understanding the supply and demand dynamics here. And of course, if you affect demand, which is basically what the Fed's doing, which is what, reducing our ability to, pump more oil here in the United States, find new minerals in copper and gold and silver and all those things that have just really restrained things here. Those actually cause bubbles to be in our system and hiccups, if you will, that cause supply and demand factors and challenges. But of course, if the demand continues to rise, like we see in copper as a result of, all this green energy stuff, demand rises, but we can't explore and we can't keep up with this trajectory of the need. Well, guess what's going to happen with the price? there's more dollar station, fewer ounces that are out there. The price is going to go up. Now, we're also looking at reshoring different parts of our economy. We don't even make any antibiotics here in the United States. I'm a type 1 diabetic, and I was told from my pharmacist that we're low on insulin as a nation. Now, that's pretty concerning stuff, given the fact that type 1 diabetics can't live without insulin. And so I think we're bringing a lot of these industries back here to the United States, or we're friendshoring them, with other nations that, can hopefully do things, lower cost than the United States could potentially. But all that transition, all this reshoring, those are inflationary ideas. So if we see a dip in inflation, it is definitely going to be going up, which then adds to our thesis of, we believe that, Fed's going to be higher for longer. We are not out of this winter yet. I think we're actually more like about to really be facing some of the real challenges as the numbers continue to unfold ahead of us here.
Right. And you can't eventually have to pay the piper. So you think inflation numbers are going to be up and interest rates are heading higher, David? Is that the final conclusion?
Yeah, I do. I think inflation's going up. I mean, there's 5 things that move markets. We've got inflation. It's not under control. We are seeing things come down, but it's going to rise again. We've got interest rate environment. There's a lag effect that's taken place. We just raised rates faster than ever before in history. I know your viewers know all about this, but it takes 12 to 18 months for those interest rates to get priced in. 1 year ago, we're looking at less than 1% of the 5% that the Fed brought in. I mean, this is not even close to being priced into our market here today. And so I think that then we see, what the Fed has ultimately done. Hey, they're radical. They're raising rates. Who knows what Powell's ultimately going to do? I think this guy's actually a lot more dovish than he claims to be at this moment. And so we're seeing a lot of hawkish speak, if you will, as he's talking about raising rates more again. Hey, we'll find out what ends up happening. It looks like it's priced in to occur here on July 24th. But I think that we're more looking at a pause right now. And we're not going to be looking at a pivot to a lower rate, though. That's the part that the market has dead wrong. And then that gets into corporate earnings as the force factor that moves markets. I think that it's really important for us to understand today that corporations have to borrow at a much higher price today than they did before. Whether we're talking about the office real estate, which is very expensive, and there's trillions of dollars coming due here over the next 18 months, or we're looking at just corporate America right now, and so many zombie companies today that require more capital to run than they actually produce. Those organizations are going to have a very difficult time making it in this new economy where, again, it's more pricey to borrow. And therefore, their margins are going to be compressed. The whole reason why we purchase stocks is because of the profitability or the margin that they're going to make. I see margins coming down significantly as the consumers is getting tighter right now. We're seeing just even the credit report that came out yesterday indicate that it was about a third of what expectations were as far as new borrowing was supposed to go over a month. So that is the lowest level we saw since November of 2020. So that's a big deal as we're seeing that begin to subside. And then the fifth thing is geopolitical events. So I don't care whether we're talking about COVID was the biggest geopolitical event in the last, several decades or centuries. Now we're looking at wars. We're looking at, a number of challenges here, with China now, very likely leading a new BRICS currency, Brazil, Russia, India, China, Saudi Arabia, South Africa, Iran. These nations are looking to gather together and rival the U.S. dollar today. And, that's not good for the U.S. dollar at all. But yet we're seeing, some strength today. So, there's a lot of people that are looking at stuff right now and they feel like, maybe the climate inside the house feels pretty good, but if we examine things a little closer, the windows are broken up, and all we did was just crank up the heat. So we can't continue to print and price this thing. We will eventually have to pay the piper. We are looking at tremendous debt as a nation. That ultimately leads to taxes. Taxes are a demand suppressor. And so again, supply and demand are these really big factors that are going to be playing in here for our future. And we cannot get past basic economics. It's just a matter of time.
So basic economics is eventually going to catch up with us, huh?
That's right. The most anticipated recession in history.
Okay, so what are you doing with your portfolio, your clients? Where are you looking for opportunities, or are you just battening down the hatches and going into full-scale defensive mode?
It's a very important question. I think that how we answer that question, is also very important. So I think we need to understand, okay, where have we been? Where are we today? Where are we going? What worked yesterday is not necessarily going to be working today, but we've been looking at the big FANG stocks. And so, there's been this saying that there is no alternative to like these 7 or 8 different stocks that just continue to lead everything. Well, I think right now it's not a TINA. There is no alternative. It's now a Terra. There are reasonable alternatives at this point. You're getting paid right now, at least at the Treasury, for short-term commitments of money. You can get paid 5%. Now, your personal inflation might be higher than 5%, so you could still be going backwards on that. So it's not going to solve all of our problems here in life. I think that the biggest place that we need to be paying attention to as far as allocation goes is, yes, the risk-return assets. We need to be very strategic in the things that we're doing. And I think that we can find out where we are in cycles. I think that there's ways of playing this that are more defensive and hedged. But I want to just draw specific attention to protected assets, where we would primarily be looking at bonds. Most people here today are either trying to beat inflation. That's going to be a risk-on strategy, willing to accept whatever the downside is, or they're going to be trying to be protected today, and they're going to be allocating to higher percentages of things like bonds. Okay, big caution though. So bonds can lose money in 5 different ways. The one that we've seen so significantly this year is that with all these interest rate rises that we just discussed, there's a seesaw effect between the value of bonds and the interest rate environment that we find ourselves in. So this is the reason why Silicon Valley Bank went out of business in 2 days. They had a run on the bank. They didn't have to mark to the market what their true value was of their assets. So they have $1 billion of treasuries. Well, actually, it's 30 to 40% less than what you thought. You just didn't have to market to the market because of some obscure law that happened in 2008 and 2009 with the Dodd-Frank Act. Okay, well, there's a number of things that are not priced in today that we're ultimately seeing. But these protected assets, in my opinion, all 5 of these areas and reasons why bonds can lose money are on the table. And that's really concerning for people that are trying to be protected today. They're trying to be more conservative. They're trying to Olay this next whatever comes. But they also need to understand that the 60-40 portfolio last year had its worst year since 2008. And the reason for that is because of the challenges that interest rates bring to bonds. But could you imagine our bond market here today, just 1 year ago, when junk bonds could trade at 4% interest? We could lend to junk bonds, less creditworthy organizations. How can you not make it at 4%, but you're somehow going to make it at 10% today? It's just not going to happen. I think we're going to see tremendous defaults. I think we're going to see Chapter 11s very specifically, which are not full bankruptcies, but bankruptcies that say, hey, debtors, we made commitments to you. We can pay you 60% of that. Just help us to reduce it. We've got a viable business. You'll get paid something versus nothing. And so that's a real big concern. So where do we go for protected assets today? I have this very simple idea that also sounds pretty obscure probably to most listeners, and that is a growth-oriented fixed index annuity. I can tell you right now, based upon math and science, I cannot prove more specifically that there is a better time in history to own a growth-oriented fixed index annuity than the present moment that we have right now. And what's amazing is that this insurance industry is actually growing at a faster rate this year than it has in any other previous year. And so, I'm somebody that's following the trend. I'm financially agnostic. I don't care. The whole goal here, just like the theme of your show, it's for financial survival. This is a journey that we're trying to get someplace. And so, how do we ride bulls and tame bears? Well, here's the deal. We got to be able to play defense when it's time to put defense on the field. We all know how to play offense. And I hope that, the market could go up 10% more. That'd be nice. It probably wouldn't change most people's retirement. If we get a drop of 30, 40, 50%, which is what I believe is coming here, in the next quarters, then that will definitely change people's retirement.
Hey, and it could very well be a buying opportunity for the so-called value investor if
Bingo.
she has not, in fact, gone extinct at this point. Well, David, interesting thing to chew over here. Your view, your take on the market, certainly not what you expect from a traditional financial planning outfit. Hey, tell us, how do we find you? How do we connect with you on the web again?
Sure. So my website is myspg.com. People can follow us up there. Got a lot of different things going on. We do a lot of educational events. We work with retirees and pre-retirees. So this is all about making plans for the next 30 plus years. Taxes are one of the most important ways that we can be doing that planning today. Do not miss out on the Tax Cuts and Jobs Act. We got 3 1040s to be able to file 3 more years of tax returns to take advantage of here. So yes, we are not traditional. We actually work on behalf of the families that we represent. We're here to try to help to make sure that they can ride bulls, tame bears, know what accounts and what amounts they're going to be drawn from in order to create the most tax optimal income plans for the rest of their life. So
all right,
that's how you find us.
We appreciate that. And if you got a question for David, myself, kl@kerrylutz.com is the email address. And of course, you can find a link to David's site right on our site, financialsurvivalnetwork.com, in the show notes to this interview. Just click through while you're there, sign up for your free newsletter. David, always a pleasure. Thanks for coming on.
Hey, appreciate you, Kerry. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.